What's up, investors? It's the Russian dude, and it looks like that the Wall Street is up to something. Because last week, only from Monday to Friday, their narrative changed completely, and they were doing completely the opposite trading activities, once again only in less than 1 week. To begin with, on Monday it was reported that the trading volume on call options on big tech companies reached a very high numbers, as you can see from this slide. Which, to be honest, kinda makes sense, because we were talking previously that technological sector was extremely undervalued and oversold. So these Wall Street companies, they were simply picking up some good deals. And it is confirmed by this next picture, which shows the total inflow into technological sector was one of the biggest in the last several years. The optimism of regular retail investors whenever they saw that the share prices of their favorite companies, they started to go up, the optimism increased as well. And this potentially was one of the very first signs for the Wall Street that probably it is time to sell, maybe to sell even prematurely, because they do know the main principle on the stock market, which is to sell whenever everyone is optimistic and to buy when everyone is pessimistic. Because, for example, according to this next graph, we can see that a lot of hedge funds, they started taking long positions in oil, and they started to cover their short positions. And guess what? Oil, commodities in general, this is one of the first basic things that comes into your mind whenever you're trading stocks and whenever your portfolio consists of relatively higher than average risk companies, such as, for example, technological sector in general. In addition to that, according to Goldman Sachs, approximately 80% of companies, they stopped doing buybacks. And I'm not saying that they stopped them completely, because there is a law that whenever your earnings report is coming, you simply cannot do buybacks, not to give an artificial influence on the price of the shares. But you already know that since 2011, buybacks of corporations was one of the biggest factor which contributed towards the S&P 500 growth. So even this temporarily slowed down, and not even just small slowdown, but once again, 80% of corporations stopped doing buybacks, which is not gonna put a buying pressure on the shares of the companies, which once again temporarily most likely will drop the prices. And another thing that the Wall Street saw potentially before us is that the International Monetary Fund, they recently revised their expectations in regards to how many rate cuts will happen in America this year. According to my previous videos, approximately 81% of the market participants, they believe that still there will be 2 rate cuts by the end of this year. And International Monetary Fund was one of the biggest organizations which recently changed their prediction from 2 to only 1 rate cut. If you've been watching some of my videos, you already know that I'm in the very same camp. Never I saw 2 rate cuts in 2024, maximum 1. So well, as you can see, more and more organizations switch to this point of view. But the most important thing about this particular statement is that a lot of the very same technological companies, these are companies which are heavily relying on borrowed capital. And borrowed capital, you obviously have to pay interest rates on this, you have to make interest payments on the borrowed capital. So whenever the rates are high, your interest payments are high. And also these are the companies which need a lot of borrowed capital. It's not like they can just use their own money, because these research and development activities, mergers and acquisitions, these are extremely expensive activities worth sometimes of billions of dollars, and well, not that many technological companies have that much cash on hand. And as a result, this news about the potential reduction of rate cuts this year, first and foremost, this is a very bad news for technological companies and other companies which are primarily relying on borrowed capital. Besides this, you already know that there is a magnificent 7 companies which represent almost 30% of the S&P 500 index. These are basically the biggest 7 companies in America. You already know which ones I'm talking about. But right here, you can see the graph. It shows the technological sector in relationship to the S&P 500 index. Well, as you can see, it is once again at the levels of the dot-com crash bubble. And as soon as technological sector starts to decline, this will drag the entire index with them. So basically you kinda can already see where I'm going with all this information. The hedge funds, the Wall Street companies, corporations, they started to see these signs in advance. That is why they did purchase some technological companies in the beginning of previous week, because they were oversold and undervalued, made a quick gains literally in the span of 1 week, and starting at the end of previous week, they started selling them once again. Because the signs are concerning, they are not willing to risk billions of dollars, they were able to make a couple of millions, I don't know, depending on the size of the company obviously, and that's more than enough for them. Because in the long-term perspective, they do see that the technological sector, the S&P 500, is due to at least small correction. And to be even more specific, right here is the chart, which shows the outflows out of technological companies. Well, as you can see, the outflows are pretty big. And to be even more specific, the total dollar value of the outflows out of the technological sector, which reached last week, is $3.6 billion. Well, there I have it, guys. Thank you as always so much for watching. Please like this video, subscribe to my channel if this was interesting, informative, or both, and see you tomorrow.